Bernie Madoff was responsible for the biggest Ponzi scheme in US history. In total, his fraud amounted to about $64.8 billion, and money were stolen from almost 4,800 clients. And you had to be somebody or know somebody to even become a client of Bernie Madoff. And I think that's the most ironic part about the whole scam. You see, he wasn't really targeting the average person like you and I, he was basically targeting the 1%. And what's more surprising about this is that his Ponzi scheme was surprisingly simple. I wanted to do this video to show you guys how simple a Ponzi scheme really is, and why not use one of the most famous Ponzi schemes of all time to do so. To start off, you can say that Bernie Madoff was extremely successful because of his accolades. You see, he had everything that a sophisticated investor would want to see. He started a firm with almost 200 employees in the heart of Wall Street, and he was even the former chairman of NASDAQ. And the NASDAQ is an electronic marketplace for buying and selling some of your favorite companies including Apple, Starbucks, Facebook, and even Microsoft. And before Bernie Madoff, companies were still using pink slips or conducting trades on paper. And if he hadn't ruined his reputation, he would still be known as a godfather of modern financial markets. So you can say that Bernie Madoff wasn't a random scrub that you would see on the streets, and many sophisticated investors trusted him just because of what he was able to accomplish. And it's safe to say that Bernie Madoff took advantage of their trust and orchestrated the biggest Ponzi scheme in US history. So it's really hard to say when this fraud first took place, but many speculate that he was already engaging in Ponzi schemes as early as 1980s. You see, he was promising investors consistent returns regardless of how well or poorly the market did. And in retrospect, we can see that this is a major red flag of a Ponzi scheme, but at the time, investors were pouring their money into the Madoff fund. And what's really funny is that it seems like Wall Street already knew that Madoff was full of bullshit even before anyone else. You see, financial firms around Wall Street avoided the Madoff fund like it was a plague. None of these big organizations ever put their money into the Madoff fund. And we know now that many of them were skeptical of the Madoff fund going back as early as the 1990s. But these other firms simply didn't want to get involved. And after doing some research, the best explanation on why some of these large firms never investigated Madoff a bit further can be explained with one quote: "Those who live in glass houses don't throw rocks." Many of these firms that are on Wall Street simply didn't want to get involved. They had way too much to lose and way too little to gain, so they did what was logical for them, and they kept moving forward and kept their mouth shut. And the craziest part about this whole thing is that Madoff hasn't done a single trade since the early 1990s. And many of these companies around him knew this because the trade had to go through them first. He was dealing with billions and billions of dollars, and there was no way that his small investment firm was able to carry out all these orders. And I know what you're thinking now: if the money didn't go onto the market, where did the money eventually end up? And this is really where we get into the heart of the Ponzi scheme. The Madoff Ponzi scheme is actually so simple that it's kind of stupid. When you invested your money into the Madoff fund, he would simply take your money and deposit it into a checking account at JP Chase. And as a viewer who's watching this video right now, I just want you to imagine for a second, you just handed Madoff a couple $1 million to be invested, but after you leave, he simply walks over to the local Chase bank and deposit your money there. And this money would forever sit in that local Chase bank account and would only be withdrawn if another investor was requesting to withdraw his money, or if Madoff wanted to buy something like expensive cars or a new home. At the peak of the Ponzi scheme, the JP checking account had a balance of $5.6 billion. And apart from using the fund to fulfill withdrawals, he was using this fund as his personal piggy bank, which allowed him to live the life of someone in the 1%. The craziest part about this whole Ponzi scheme is that this whole scheme lasted a total of 17 years. And by the time he was caught, he had a whole team of employees who specialized in producing fake statements to calm down investors, and they would also backdate transactions to make it seem like your money was earning you huge returns. I do want to say that I think Madoff always knew that this Ponzi scheme would eventually come to an end. And he did mention that he wanted to turn this thing legit, but the balances that he controlled grew out of control. You see, his company had been faking profits for almost 17 years, and the $19 billion given to him by his clients had ballooned to almost $64.8 billion. And there was really no way he was going to get an extra $45 billion out of nowhere. The thing you have to remember about Ponzi scheme is that it gets harder and harder to keep the thing going because you're going to owe your clients more and more money as time goes on. And Madoff himself knew that this fraud would eventually be uncovered somehow. His Ponzi scheme would eventually come to an end during the 2008 recession. At that time, other funds were losing money left and right, and he was the only one making money. and his customers wanted to withdraw money from his fund to compensate for some of the lost income. This would amount to a total of $7 billion in withdrawal requests, but he only had about $300 million in his Chase checking account. And I think it's pretty logical to assume that Madoff knew that it was over. There was no way he was going to pull out $6.7 billion out of nowhere. And because of this, he would choose to tell his sons about the fraud. And according to the official story, Mark and Andrew would turn their father into the authorities. See, I'm not really sure how much I buy this explanation. It seems like at that point, Madoff knew that he wasn't going to get out of this scotch-free, but he also didn't want to take his sons with him. And being the suspicious person I am, I have the feeling that his sons didn't go straight to the authorities. Maybe they argued a bit to see how they can get out of this situation, or maybe the sons knew about the fraud. But regardless of what actually happened, Madoff ended up taking responsibility for everything that happened, and his sons were cited as the ones who finally exposed this massive fraud. But if Madoff did intend to save his sons, it ended up not playing out that way. You see, his son Mark would die of suicide in 2010 after suffering from depression, and his other son Andrew would die in 2014 from cancer treatments. And Madoff himself would eventually be sentenced to about 150 years in prison. And as of 2020, Madoff seems to be at the end of his life. He had suffered a heart attack previously and was also diagnosed with kidney cancer, and his lawyers even argued for his early release because of that. But that request was ultimately denied. You can say that the Madoff scam is pretty much the most iconic Ponzi scheme of all time. And the same formula is used again and again to scam newer generations. Nowadays, you see a lot of cryptocurrencies being used to implement the classical Ponzi scheme that Madoff ran. In the SEC versus Shaver case, an organization promised investors a return of 7% per week from Bitcoin. They would request money from random strangers on Bitcoin forums and claim to have found the perfect Bitcoin arbitrage opportunity. But just like what Madoff did, instead of actually investing or using that money from arbitrage, they pretty much funneled that money into a bank account and spent that money buying homes, cars, and whatever they really wanted to buy. And as the scam got bigger and bigger, it became more difficult to pay off older investors with the money of new investors. This led to delays in withdrawal by customers, and for many people, it took weeks and months for them to get their money. The exact same thing actually happened to Madoff near the end of his fraud, and he would make up excuses to delay the withdrawal process as much as he could. I wanted to mention this because this is one of the biggest red flags of a Ponzi scheme, and regardless of what explanation the company tries to tell you, always be suspicious of delayed activities like this, because more likely than not, your money's not there anymore, and that's a scary idea. Other than this, you also want to be looking for overly consistent returns or pretty exaggerated returns with little risk. The Madoff fund was always able to generate a return of about 12% regardless of how the market did. And the Bitcoin scam that I mentioned earlier promised investors a return of 7% per week. And actually, if we think about this, we can see how ridiculous this is. If you put in just $1,000 with these Bitcoin scammers, you would have a total of $33,725 by the end of the year. And if you leave your money with these scammers for about 2 years, you would have a supposed return of $1,137,399. And what's really funny is if you leave your money with these scammers for about 3 years, you would have a return that's more than what's physically possible or what physically exists on our planet right now. And I'll leave the number for you guys right here, but I don't even know how to pronounce this. And the last thing I want to leave with you guys is don't invest into things that you don't understand or things that you can't get complete information on. If you sense something strange about what you're investing into, then there's usually something wrong with it. And the lack of transparency is always a bad sign from any organization, especially one where you're putting your money in. These are just some of the general guidelines I want to leave you guys with, but there are cases out there that more or less belong in the gray area. So be careful about organizations that have trouble giving your money back. Be careful with organizations that have a lack of transparency. And lastly, be careful about organizations that promise you extremely high returns for little risk, or organizations that promise you an overly consistent return. I really do hope that this video helps someone out there save a lot of money. And thank you guys so much for watching this video. Make sure to like and subscribe, and like always, I'll see you guys again next time.